Our next speaker is Nigel Grantham. Nigel is head of FinPro and in 2021 was appointed to chairman of Marsh Specialty New Zealand. Great. Leading liability broker who brings more than 30 years of experience both in the insurance industry, both here and offshore. And he's been recognised in the past for his considerable contribution to the insurance industry and for client feedback that he's got. Today, Nigel's going to cover all those burning questions that you have about changes to directors and officers insurance, as well as the current landscape. So thank you, Nigel.
Arrows up, down?
The right. The right one.
Yes.
Yes, well done.
So, good morning, everyone. I am a Marsh employee, so in case of emergency, I'm out that door.
Brilliant.
The other thing is that COVID has allowed me not to present to people, so a huge number of people here, and it's quite intimidating. So work with me and help me through my nervousness around my presentation. And feel free to look at your phones. I won't be offended. Things to do.
Multitasking.
I just wanted to give you a historical snapshot of where we were with respect to the D&O market. And I look around the room and I look at the roles that you play as officers of the company. Some of you might even be deemed directors with the amount of responsibility you have. It's very important for you to understand perhaps the D&O environment. Director asks you something in a way with knowledge of what is required on it from a D&O placement, and it might be important for you to explain the seriousness of the response to your directors. But I just wanted to go back and do perhaps more 10 years ago than 5 to 10 years ago. D&O insurance had very little visibility from the board. It was pretty much relegated down beyond that to not even the CFO, but a purchasing officer or purchasing manager. We had very little time where the board was particularly interested. And I think that was just actually through a lack of coming out of the environment. And that's changed quite a bit now, which I'll go into. But we had insurers competing very aggressively for market share, so much so that the pricing was, I can only say, cheap. And it was almost bragging rights to see out of the NZX50 client. So that helped very much for the consumer being a client and ourselves in respect to our negotiations. But there's very little differentiation between public and private companies. The pricing was based really on the capacity provided. So to give you a flavour of the differentiation, you might only be paying 1,000 to 2,000 per million of cover. And I'm talking private companies who are New Zealand listed only, not dual listed. So very, very cheap. Wide policy coverage. With insurers competing aggressively for market share, they would extend policies and enhance policies to try and get ahead of their market. It lasted about a day, so whatever you put out as a enhancement to your policy would be replicated within a matter of days from the other insurers. So it was interesting to see how that developed. As I said, an abundance of capacity. In the New Zealand market, we've got 8 insurers. 4 or 5 of those are global, and 3 underwriting agents who underwrite on behalf of Lloyd's of London syndicates. We would think around about $200 million of capacity, which would actually swallow up most New Zealand companies. There was a few, perhaps NZX10 companies that bought a little bit more than that at that time, but not many. And the structure of the placement was different because I'll just give you a flavour of how the D&O policy is structured. We have what's called side A and side B, and you might say, well, how the heck did they ever dream up that sort of thing? But many years ago, D&O policy was written on one piece of paper, side A, side B. Contract now like that. Side A was D&Os for personal liability that a director may incur, their obligations to the company and its stakeholders. Side A covered the director personally if the company did not indemnify them or was unable to indemnify them, i.e. it was in receivership. Side B was one where if the director was able to be indemnified by the company, then the insurer would step in and pay those costs of legal representation or any liability that was sheeted home by way of settlement or judgment. And then later there was introduction of side C. I don't know how that fits on the side A and B paper, but side C. Side C really is securities claims cover for the company. And that has its own complications, but back then you could have a side A and side B cover, and a tower cover, and a side C standalone. So there was no conflict around a claim being paid on a side C tower, because it was pretty clear securities claims, or where the claim was made against the director individually. I'll move to the current market influences now. So what influences insurers now? I'll go on to actually how the insurance market has changed. But what we're seeing in the last, say, particularly just the year before COVID, there was a slight change in the market. The market had got to a level where we term it as a soft market, so much capacity, very cheaply priced. Remember, an insurance company just is lending its balance sheet to the company and charging a premium. So, in looking at assessing its own risk, some of that those placements were extremely competitive, and therefore they look to rectify and remediate the rating. And we in New Zealand, we're affected by global trends. All the insurers here are either parent companies in the USA, Australia, UK, Europe, and the events that occur offshore really sprinkle down here quite dramatically in respect of insurance. So overseas rates were rising, class actions. Everyone knows how many class actions have been happening in Australia. Similar in the USA as we've gone on for years, and in the UK and Europe as well. So there was a fear that especially in Australia, there would be a class action regime coming over and there hasn't quite been that case. Really, we can only talk about a number of major losses that really are on one hand in respect to that. So in New Zealand, it's been pretty relatively benign in that respect. Give you an example, in Australia, the last 6 years, they're looking at $1 billion of claims paid or reserved to be paid versus something like $300 million of premium. So there had to be a change there, and anyone who sits on a board with a dual listed company or an Australian director will certainly know the cost now of D&O. Now insurers are looking for a board member or a number of board members and senior management to do a personal presentation when we come down to renew the D&O cover. And it's vital that that is even seen to be in progress, because if an insurer sees that the company's not come along, they think that they're not really interested in providing any information that might be of use for the insurer to assess the risk. The composition and experience of the board, diverse board, wide experience of the board, that's extremely important component. 10 years ago, the only sort of factors that were taken into consideration really were the financials a little bit of CSR, corporate social responsibility, which really wasn't embedded in the organisation. And ESG, of course, Corey's going to make a talk about that, and it will be embedded in organisations. Interaction with management and board, so the trust and the transparency between management and board. The insurer will want to know how that integration is. Culture and conduct, very important. Values-based organisations looking for sustainability. We've had our own interesting situations in New Zealand here, recent times, media company, around culture and conduct. Industry type, what kind of industry you're involved in. And insurers will look at sort of what they believe to be outliers now. They won't not provide cover, but when you're looking at, say, SPACs and disruptive technology, fintech, financial institutions, mining, casinos, airlines, they'll scrutinise those a lot more closely. Even in that situation, insurers' own ESG requirements, these are all public listed companies, except for Lloyd's Market. Some globals are all public listed companies. So they'll have their own scrutiny around what business they write. So shareholders will not want to know what kind of business they're writing. We know some insurers that are now not writing mining companies, fossil fuel, etc. It's just not part of their risk appetite. So there's quite a squeeze on some of the mining companies in Australia, for instance, around getting appropriate cover. And there's greater scrutiny of financials and forward-looking guidance. So there's a lot of financial metrics that go into the assessment of the financials. And if possible, if there's a board director there at the meeting, giving some area of forward-looking guidance without giving away confidentialities. It's not a case of just saying, well, please read the annual report. There's a lot more discussion that needs to be had around this, because you're gaining the trust of the insurer, and the outcome is that the insurer, if they are confident to you and comfortable with you, what you answer, they're going to provide capacity at a better price. That's pretty simple. ESG representations, we're seeing litigation with respect to greenwashing, representations made in reports, not following through, or over-assessing or over-representing the position. So that's a real key risk area for insurers. Cyber, as mentioned Peter before, around the cyber resilience and how they're managing their cyber security. There's just an enormous amount of increase of denial of DDoS, ransomware attacks. I believe, look at 4 years, cyber insurance, I think 3 or 4 years. Spend your money on assessment around your cyber activities. But of course, directors have fiduciary responsibilities, and one of those is clear on how they deal with cyber risk. Legislation, I've just named a few there in respect to what's happening, in a lot of legislation going through on the ESG side of things. So directors need to be aware and understand those, and of course around the room, this is maybe a hot topic for all you people. Changing class action environment in Australia. All commissions looking at the thresholds around bringing class actions and litigation funding. And in New Zealand, law commissions looking at the class action regime and litigation funding as well. So in New Zealand, it actually might get worse after they've had their deliberations. Regulators increasing the enforcement provisions around breaches of statute. Supply chain, Peter mentioned that. Supply chain insurers will want to know where the products are coming from, where producing products, where they're coming from, who is producing them, where from, and geopolitical events. is a hot topic as well. A mention of Taiwan, Ukraine, Ukraine, Russia. We've got exclusionary language around that. People maybe wouldn't be surprised with that. There. Taiwan, China issue could be interesting because if sanctions get placed onto China, then we may be affected by that. And China's got, I think, our biggest trading nation, so that may have serious implications around getting D&O cover. So who wants to be a director? So the current conditions, interesting. We've got the existing established market in New Zealand, which is a mature market, good quality grade paper, A+, Standard & Poor's and above. Versus new markets coming in predominantly out of London. And those new markets have had very affordable capital in the last few years, as we know with QE and the likes, raising capital has been very easy, and they're putting that capital to work. And they're identifying New Zealand, especially as a market where I think there's been perhaps some opportunistic pricing. I talk to insurers, I call it predatory pricing, maybe opportunistic. And states, I know that they've had 16 straight quarters of increases in D&O premiums. So our FinPro head over there, she's saying enough is enough, because there's not enough selection around risk or around portfolio underwriting. There's some pairing of capacity from the incumbents in New Zealand. However, that capacity has been able to be swallowed up by new markets. And surprisingly, with all these influencing factors, the pricing coming out of London is starting to come off quite markedly, especially in the excess layers. So how you build a program for a large corporate, you'll have a primary layer, which might be 10 or 20 million, and then depending on the instructions from the client, you might have to build it up into hundreds of millions, and you'll do that by way of slabs of capacity, so to speak, building your blocks up to get you up to your top level. So on this excess layer layers, then we're seeing quite a bit of activity. I don't know if there's any insurer in the room, but no doubt they might say no, there isn't. But anyway, so we're seeing some primary layer interest as well. It's really just a momentum change in the market. The cycle is moving. Insurance markets work in cycles. Availability of capital is freely available. Pricing comes down. When it's not available, pricing goes up. There's also now side A availability, which is really protection for the directors in case the tower for the company's directors is blown out, exhausted by claims. So directors can actually buy a block of cover for them personally, because the company won't be there, it might be insolvent, and they're left still with some liability exposed. And the policy coverage offering is still quite meaningful. There is some exclusionary language coming in around modern slavery, around cyber, and other areas, but by and large, the policy coverage is still meaningful. That means directors can operate companies in an environment where they know they can, if they there's allegations against them for wrongdoing, wrongful acts, their duties, pretty much they can count on that D&O policy to respond, provided it's not willful or criminal. So you can all go back to your directors and say, good news, we're getting the pricing to come down if you're with Marsh. So what does the future look like? Well, it's very delicately poised because, of course, it could any event could occur where capital is withdrawn. The markets rely on capital and capacity that is provided. So you all know the global economy, what's happening. In some areas, it's mostly going to be more distressed than others. In New Zealand, we're looking at the safe harbour provisions coming off. Expect solvencies and receiverships to to increase quite dramatically. Interest rates rising, there's no cheap money as such anymore. And you need to look at the Federal Reserve for their comments the other day about the tightening there. Above all, they're trying to get the inflation down by increasing interest rates and withdrawing money supply out of the States. Solvency will be a big question around from the insurers around, especially the forward-looking guidance. Inflation just needs to get under control. Wage inflation and inflation is a desperate cycle downwards. Class actions in New Zealand. The Law Commission's deliberations will come out at some stage. Maybe a better landscape for litigation funders to step in and look for opportunities. Geopolitical events I've mentioned before, if they exacerbates or gets worse in respect of certainly John Wilmer has read his head for a while, so might come looking again, but China, Taiwan is obviously a very big concern. And then any other black swan events, I haven't mentioned COVID at all, but it's always in the backdrop as well. That's it for me. I mean, really around the room, it's important to perhaps understand that if you are involved in the collection of data, material analytics, or a D&O renewal, asked you to prepare, it's quite critical that the responses that you provide, the thoroughness around those responses can make a huge outcome, a difference in the outcome of the renewal negotiations. To give you a flavour, I talked about $1,000 or $2,000 per million. If a company here or is dual listed is looking to insure, it might cost them between $30,000 to $50,000 per million of cover, and directors these days are wanting a lot of cover. So it's a significant spend, and of course, with a public listed company, they can declare that they buy D&O insurance, and amazingly, we've got to say it's a fair and reasonable price, but I've never heard anyone say the D&O premium is a fair and reasonable price. It's always too expensive. Thank you. That's it for me. I'm cognizant of the fact that lunch is after me, so I would expect the same level of questions that Peter got.
I do have a question. I do have a question. Hi, thanks. That was great. To talk about the cost of cyber insurance being, almost prohibitive moving forward. Do you see other areas where there's going to be a similar?
The problem with cyber is that no one knows how bad actors are going to come in. You can't actually assess the risk because it's changing so completely. I didn't dwell on ESG because ESG, the risk that is evolving rapidly as well. I mean, Marsh has risk rating models, analytics to get a client to prepare and complete. But really, sometimes that can be a double-edged sword, because if you've done nothing on the S side, but you've done everything on the E side, the insurer may go, well, it's great on the E side. What have you done on the S side? You've done nothing. So well, it's a not monstrous sort of activity that we're trying to work through. It's not just a couple of months' work. But cyber, if we go outside liability, then natural catastrophes, natural disasters is going to be a big problem going forward. But from my angle in the liability space, the cyber side of it is getting pretty dire. We've had public listed companies say, look, we'd rather spend the increase in the premium and the paring back of coverage on our IT security, and we'll manage it that way. It's a bold call, but at the end of the day, some of the premiums are getting up into the seven figures. So you've got to take a view at some stage.
Thank you.